For more than 6 centuries, every dominant currency on Earth has followed the same unforgiving pattern. Not most of them. Not some of them. All of them. A perfect 100% failure rate. It started with the Portuguese real, the currency that once controlled the world's seas. Then the Dutch guilder took over, the backbone of the first global stock markets. After that came the British pound, the symbol of an empire that touched every continent. And finally, the US dollar, the world's financial heartbeat. Each one enjoyed its moment at the top. Each one reshaped trade, politics, and power. And each one lasted between 80 and 100 years before something shifted, slowly at first, and then all at once. The dollar entered that timeline in 1944, which means today, in 2025, it's 81 years into the cycle. The exact window where every previous reserve currency began sliding into decline. This isn't prophecy, and it's not doom talk. It's math. It's incentives. It's how global power behaves when money becomes the tool and the weapon. And over the next few minutes, you'll see the entire 7-stage cycle that every reserve currency has gone through, where each one rose, peaked, cracked, and eventually collapsed into something new. Most importantly, you'll see exactly which stage the US is in right now, and why the signs aren't happening in the future. They're already unfolding in front of us. But to understand how we got here, we need to start with stage 1, the beginning of every empire's rise, and the quiet seed of its eventual fall. Most people think a reserve currency simply means strong money, stable, trusted, backed by a powerful nation. But that's only the surface. A true reserve currency is something far bigger and far more powerful. It's the currency that other countries hold in their vaults as protection against crisis. It's the currency that global markets use to price nearly every major commodity: oil, copper, wheat, natural gas, even shipping rates. It's the money that settles international trade, from Asian electronics to Middle Eastern energy to South American minerals. And with that role comes something economists call the exorbitant privilege, a polite way of describing an advantage so massive that no empire ever wants to give it up. When your currency becomes the world's default, you can print money and receive real goods, resources, and labor in return. You can run deficits for decades without facing the consequences that crush other nations. You can borrow at ultra-low interest rates, even when debt piles up to historic highs. And global demand for your government bonds becomes almost automatic because the world needs them to function. This creates a foundation for unbelievable global dominance, military power, trade power, financial power. But it also creates the one thing every empire has eventually fallen victim to: overreach. Because once the world depends on your currency, it becomes dangerously easy to stretch that privilege too far. And that's where the first cracks always begin. Stage 1. Military power and trade route control. Every reserve currency begins with the same foundation: not banking, not finance, but control over global trade routes. The world doesn't trust a currency because it's pretty or because a government says it's strong. It trusts it because the nation behind it can protect the flow of goods that everyone depends on. Portugal wasn't the richest country when its currency took the lead. It simply dominated the seas. The Netherlands didn't have the largest population, but it controlled the major shipping lanes of its era. Britain became the center of global finance because it commanded the world's oceans, with a navy so large it could enforce trade rules almost anywhere on the planet. The pattern is unmistakable. Trade route dominance leads to currency dominance. And after World War II, the United States inherited that exact position. Today, the U.S. operates 11 carrier strike groups, more than every other nation on Earth combined. It maintains a military presence near almost every major choke point: the Strait of Hormuz, the South China Sea, the Suez Canal, the Panama Canal, the Malacca Strait. 90% of global trade touches routes that the U.S. can influence, monitor, or protect. This geopolitical network didn't just support the dollar, it elevated it. By 1945, the U.S. growth had already completed stage 1. And unlike past empires at this point in the cycle, America still holds this advantage firmly. But military dominance is only the first step. What comes next is where real financial power begins to take shape, and where the cycle becomes almost impossible to stop. Stage 2. Export surpluses and wealth creation. Once a nation controls global trade routes, the next shift happens almost automatically. The world starts buying from them. This is the wealth creation phase, the part of the cycle where the dominant power becomes the planet's primary exporter, manufacturing hub, and economic engine. Portugal used its naval reach to create one of the first global arbitrage systems, moving Asian luxury goods into Europe at enormous markups. The profits were staggering for the time. Then came the Dutch. Amsterdam became the world's warehouse, a centralized hub where goods from every corner of the globe were stored, traded, and redistributed. They mastered the art of global arbitrage and financial innovation, converting trade dominance into unprecedented wealth. Britain pushed the model even further. With the Industrial Revolution, it became the planet's factory. Textiles, steel, machinery, British goods filled markets worldwide, generating enormous surpluses and expanding imperial reach. And after 1945, the United States stepped into that same pattern with overwhelming force. From the end of World War II through the late 1960s, the U.S. ran the largest trade surpluses ever recorded in the modern era. American factories produced everything the world needed to rebuild: cars, machinery, consumer goods, industrial equipment. Foreign nations paid in gold, and mountains of it poured into Fort Knox, giving the U.S. the deepest reserves on Earth. This was the peak wealth creation stage, the high point where a reserve currency becomes more than a financial tool. It becomes a symbol of reliability, strength, and prosperity. But surpluses never last forever. And the next stage is where every empire begins its subtle shift from discipline to dominance-driven temptation. Stage 3. Formalization of reserve status. Every empire that dominated global trade eventually reached the moment where its currency wasn't just important, it became officially recognized as the world's financial foundation. This is, honestly, the peak of power, the point where strength turns into structure. Portugal achieved it in the 1500s, when its trade networks stretched from Brazil to India. The Dutch followed in the 1600s, as Amsterdam became the center of global finance. Britain secured it in 1815 after its victory at Waterloo cemented the pound's role worldwide. And the United States reached this status in 1944, when the Bretton Woods Agreement crowned the dollar as the world's reserve currency, a position backed by unmatched gold reserves and unmatched industrial dominance. But here's where the cycle quietly turns. Formal reserve status is not just a privilege, it's a trap. Economists call it the Triffin dilemma. The idea that once your currency becomes the world's default, the global system requires you to run deficits. The world needs your money to function, which means you must constantly supply more of it, even if it means, undermining your own industrial strength. And that's the tipping point. Deficits begin to grow. Manufacturing slowly shifts overseas. The economic engine that built the empire starts to weaken, piece by piece. Every reserve currency in history began its decline immediately after this stage. The United States was no exception. And what comes next is the phase where empires try to hold on to dominance by shifting from production to something far more fragile. Stage 4. Deficits and overconsumption. Stage 4 is where, honestly, every dominant empire makes the same fatal shift. It stops producing wealth and starts consuming it. The engine that once powered global trade turns into a vacuum, pulling in goods, resources, and credit from the rest of the world. Portugal experienced this first. Instead of expanding industry, it relied on a flood of Brazilian gold to fund its lifestyle. The wealth looked endless, until it wasn't. The Dutch followed a similar path, drifting from production into passive finance. Amsterdam grew rich on fees, banking, and speculation, but not on making things the world needed. By the early 1900s, Britain fell into the same trap, importing far more than it exported. The pound remained strong, but the country's industrial core had already begun to erode. And then came the United States. The U.S. ran steady trade surpluses for decades, until 1971, the year the surplus flipped into a deficit, never to return. By the 2000s, America wasn't just running deficits. It was running the largest trade deficit in world history, year after year. Yet the dollar stayed strong. Not because the fundamentals were healthy, but because the global financial system needed dollars to function. Countries kept sending goods, America kept sending paper, and the cycle of imbalance grew deeper with every passing year. This is the stage where comfort disguises decay, and where the next shift becomes, inevitable. Stage 5. Debasement and money printing, America now. When an empire's deficits grow too large to hide, and its economy can no longer produce enough to cover the gap, every government throughout history turns to the same solution: debasement. It's the quiet method of paying yesterday's bills with tomorrow's money, and it never ends well. Portugal did it by diluting its silver coins, stretching precious metal content thinner with every issue. The Dutch printed aggressively to finance their expanding wars, weakening the very currency that had built their wealth. Britain followed the pattern with multiple pound devaluations after World War II, trying to manage debt loads that were no longer sustainable. The United States has now reached this stage, openly, visibly, and on a scale the world has never seen. In 2008, during the financial crisis, the US instead launched quantitative easing and created roughly $3.5 trillion out of thin air. At the time, it was described as temporary. But then came 2020. Between 2020 and 2022, another $7 trillion flooded into the system, the fastest expansion of the money supply outside of a major war. And the effects showed up instantly. The dollar's purchasing power dropped sharply. Prices climbed across nearly every category. Savings lost value, real wages fell behind. And for the first time in generations, global investors began whispering the one thing reserve currencies fear most: confidence is cracking. This is the stage where the world starts asking dangerous questions. And the next stage is where those questions turn into action. Stage 6. Confidence erodes, alternatives emerge. Stage 6 never arrives with an announcement. There's no press release, no dramatic collapse, no global summit declaring the end of a currency. It always begins the same way: quiet diversification. Nations don't walk away from a reserve currency, they tiptoe. History shows this pattern clearly. Before the Dutch guilder fell, European states slowly shifted deposits into silver. Before Britain lost the pound's dominance, central banks quietly increased their dollar holdings. Confidence never breaks overnight, it erodes. And today, that erosion has already begun for the US dollar. Across the BRICS nations, central banks have been reducing dollar reserves for more than a decade. China and Russia are buying gold at a pace not seen since the 1970s. Saudi Arabia, the anchor of the petrodollar system, has begun accepting yuan for oil sales, something considered unthinkable just a few years ago. Meanwhile, the dollar's share of global reserves has fallen from 72% in 2000 to roughly 58% in 2024, a slow, steady slide that mirrors the early decline of every past reserve currency. Regional settlement systems are emerging in Asia, Africa, and South America. Trade blocs are experimenting with local currency settlement. Even UST allies are quietly increasing gold reserves as a hedge. The world isn't abandoning the dollar, not yet. What it's doing is far more important: hedging against it. Stage 6 is always silent, gradual, and once it starts, it never reverses. Stage 7. Collapse and what comes next. History is blunt about how this final stage unfolds. The world doesn't wait for a collapsing currency to fix itself. It simply moves on. Not in a dramatic flash, but through a gradual shift towards something more stable, more trusted, or more balanced. When Portugal weakened, its real didn't just fade. It was overtaken by the surge of Spanish silver flowing across the world. When the Dutch guilder lost credibility, global finance realigned around the British pound. And when Britain could no longer sustain the costs of empire after World War II, the world migrated to the US dollar almost automatically. The same question now hangs over the modern system. What replaces the dollar? No single country today checks every box needed for reserve dominance: military power, trade route control, deep financial markets, political stability, and global trust. China is rising, but lacks transparency. Europe is large, but fragmented. Emerging powers have momentum, but not scale. That's why many analysts believe the next era won't revolve around one currency at all. It will likely be multipolar, a mix of regional currency blocks, alternative settlement networks, and a heavier role for gold-backed reserves. Some even expect a future digital reserve basket, built to reduce dependence on any single nation. However it unfolds, the transition won't be clean. Global volatility rises in every historical example. Purchasing power erodes faster, and the dominant currency, even before it loses the throne, experiences the most damage. Stage 7 isn't the end of money, it's the end of a cycle, and the US is closer to this stage than most people realize. Most discussions about reserve currencies feel abstract, something for economists, politicians, or historians to worry about. But when a reserve currency declines, the people who feel it first, and the people who feel it the most, are ordinary citizens. Every empire in this cycle shows the same pattern. When Portugal lost its monetary dominance, everyday families saw their savings evaporate. When the Dutch guilder slipped, merchants and workers watched purchasing power fall faster than wages. When Britain's pound gave way to the dollar after World War II, the British public absorbed wave after wave of devaluation. The US is not immune to these forces. Since 2020 alone, the dollar has already lost roughly 25% of its purchasing power, with prices for essentials rising far faster than most incomes. That's the early signature of a currency under strain. And it's happening before any formal transition has even begun. If Stage 7 eventually unfolds, history suggests a few outcomes are more likely than others. The dollar could lose 30 to 50% of its value in a compressed period. Bondholders, cash savers, and pension-dependent retirees would be hit hardest because fixed-income assets fall fastest when currency value drops. And the transition itself would create turbulence, painful for those unprepared, but full of opportunity for those who understand the cycle and position themselves early. A reserve currency collapse isn't just a geopolitical event, it's a generational shift, one that reshapes wealth, savings, and stability for millions. When you understand the full arc of this cycle, the rise, the peak, the erosion, and the reset, you stop reacting to headlines and start recognizing the deeper forces shaping the global economy. Because every major currency decline in history has split people into two groups, those caught off guard and those who recognized the shift early enough to adapt. And while every era is different, the patterns are remarkably consistent. History shows that individuals who understood these transitions weren't more talented or luckier. They were simply paying attention to the signals others ignored.